Starting to invest can be overwhelming, and it's common for beginners to make mistakes that can be costly in the long run. However, there's no need to fret. In this video, we'll share the top 5 mistakes that new investors make and provide valuable tips on how to avoid them. Whether you're just starting or looking to improve your investment strategy, this video is a must-watch. So join us as we explore the common pitfalls of beginner investors and help you become a smarter investor. Investing is a crucial aspect of building wealth and achieving financial stability in the long term. It's a way of putting your money to work for you, generating returns that can help you achieve your financial goals. However, for beginners, investing can be challenging, especially if you don't have the right knowledge and experience. That's why it's important to understand the common mistakes that beginners make and how to avoid them. Unfortunately, many beginner investors make mistakes that can be costly, both financially and emotionally. These mistakes range from investing without a plan, not diversifying their portfolios, trying to time the market, not doing research, and letting emotions drive their investment decisions. By understanding these mistakes and how to avoid them, you can build a solid investment strategy that helps you achieve your financial goals. To help you avoid these pitfalls, we've compiled the top 5 mistakes that beginners make when investing. By recognizing these mistakes and following some guiding points, you can develop a smart investment strategy that helps you achieve your financial goals. So keep watching as we explore these mistakes and provide you with the necessary tools to succeed in your investment journey. Number 1. Not getting started. One of the most significant mistakes that beginner investors make is failing to start investing altogether. The stock market can be intimidating, and it's normal to feel some fear or uncertainty around investing. However, not investing at all can be the biggest risk to your financial future. As a beginner, you may spend a lot of time researching and trying to build the perfect portfolio before taking the plunge. But often, this creates more procrastination and noise than necessary. The most important thing is to start investing as soon as possible, even if it's just a small amount. Investing in a low-cost, globally diversified equities fund can give you a practical understanding of what it feels like to be invested. This experience is more valuable than spending hours reading about complex investment strategies. By taking action and getting started, you can begin to build your investment portfolio and achieve your financial goals over time. Number 2. Trying to time the market. Investors, both new and experienced, continue to struggle with market timing. Market timing is the idea that you can get better returns by buying into the market when stocks are low and selling out when stocks are high. It can be tempting to listen to the financial media when the headlines constantly claim that markets are at an all-time high. In this situation, market timers may hold back, thinking that a market drop is imminent and that they can jump back in when the price has dropped. Even for professional investment managers, this is almost impossible to get right consistently. Our best bet is to remain invested and ignore short-term fluctuations. You can overcome this anxiety of the ups and downs of markets by spreading the time over which you invest. For example, investing a portion of your income monthly dollar cost averaging, or if you have a significant sum of money to invest, splitting that into smaller investments throughout the year. Comment invest if you would like to see more videos on investing. Number 3. Tampering with your portfolio. When it comes to investing, the adage less is more rings true. While being engaged in your investments is crucial, making too many changes too often can have negative consequences on your results. The investment space is highly competitive, with a vast array of platforms and funds available, making it tempting to switch frequently to what appears to be a better option. However, frequent changes can lead to excessive fees and missed opportunities in the market. Successful investing requires discipline and patience. A well-constructed portfolio from the beginning will not need frequent adjustments. Ironically, having the discipline to resist the urge to tinker with your portfolio is what requires the most effort. This is where the assistance of a professional can come in handy. By engaging a professional, you can receive guidance on setting up a suitable portfolio and have the discipline to leave it be, allowing you to achieve better long-term results. Number 4. Playing it too safe. Novice investors often make the mistake of being too cautious with their investment portfolio. and not allocating a high enough proportion of equities in their portfolio. The fear of market volatility can make it seem safer to hold assets that are historically less volatile, such as bonds or cash. However, market data has consistently proven that equities have a much higher expected return over the long term compared to these safer assets. It's essential to have a long-term investment mindset when thinking about investment returns, spanning at least a decade, if not several decades. Any money used for investment should only be money that you don't need in the short term. While starting with a relatively conservative portfolio is a sensible approach for novice investors, it's essential to start gradually leaning the portfolio towards more equities over time while still maintaining broad diversification. By taking calculated risks and investing in equities over the long term, investors can expect to reap high rewards. If you would like to watch the video on investing for beginners, you can click the card above. Number 5. Riding high on early wins. As a beginner investor, it's essential to recognize that investing is a long-term game, and success is not measured by a few quick wins or losses. While it can be tempting to attribute early gains to investment skills or market insights, it's crucial to understand that short-term market movements are typically out of our control and driven by unpredictable factors such as news, rumors, or even social media trends. Moreover, early success can create a false sense of confidence, leading investors to make unnecessarily risky investment decisions in search of more significant and faster returns. This overconfidence can cause investors to ignore critical investment principles such as diversification, risk management, and disciplined portfolio rebalancing, leading to significant long-term consequences. As a beginner investor, it's vital to stay grounded and focus on building a well-diversified, long-term investment portfolio. Short-term market fluctuations and noise should be ignored, and instead, investors should remain committed to their investment strategy, remain disciplined, and avoid making rash investment decisions based on emotions or short-term trends. And that's it for today's video on the top 5 mistakes beginner investors make and how to avoid them. To summarize, we covered the importance of getting started, avoiding market timing, not making too many changes to your portfolio, holding enough equities, and not being swayed by short-term wins. By keeping these points in mind and taking a long-term view, you can build a well-diversified, balanced portfolio that can help you reach your financial goals. We hope you found this video helpful and informative. If you have any questions or comments, please leave them below. Don't forget to subscribe to our channel for more helpful videos on investing and personal finance. Thank you for watching, and we'll see you in the next video.